The stock market is rigged, but that doesn't mean you can't profit from it. If you invest in the stock market, I can guarantee you've thrown up your hands in frustration and shouted, "This is all rigged," at least once. And while I'd like to tell you that this isn't the case, the truth is that in a number of ways, the market is rigged. But why should that necessarily be a bad thing? After all, isn't it much easier to learn a game with rules than one that thrives completely on chaos? In this video, we'll talk in detail about the ways the stock market is and is not predictable, and how you as an investor can better accept your role in the quest for long-term profits. Thank you for watching this video. But before we begin, if you could, please take a minute to subscribe to my channel. And if you enjoy this, make sure you hit that like button. Also, if you know someone interested in options, please feel free to share this video with them. Now let's get started. When people say the market is rigged, they're usually referring to the fact that it is stacked against the individual investor. After all, massive institutional players with deep pockets always seem to have the upper hand. Using their considerable connections and leverage, they can move stocks and even entire indices in ways that individual traders could never dream of. While this can be extremely frustrating at times, it's something veteran traders have not only learned to accept, but to anticipate. And therein lies the other side of the coin. Sure, you can't outbid JP Morgan or Vanguard, but you can alter your strategy so that their manipulations affect you less and less. Let's take a closer look at what I mean. Let's begin with some perspective. The stock market is vast, with the S&P 500 boasting a mind-boggling $36 trillion in total market capitalization. Now, aside from the fact that a number like this is too large for many of us to comprehend, it also tells us a number of things. Meanwhile, the average institution has a cap of around $73 billion. In fact, in the US stock market, around 78% of all market value is owned by institutions. For the large cap S&P 500, that figure goes up to 80%. Apple, Microsoft, Amazon, ExxonMobil, these are some of the biggest and most profitable companies in the world, and individual investors own just a fraction of their total shares. I tell you this to illustrate the true scale of what individual investors are up against. It also explains why. Individual investors can't influence price swings. One of the prevailing myths I often hear is that small investors can significantly impact stock prices by buying a few hundred or thousand shares. The truth is, it's almost impossible for small investors to swing prices. Institutional investors, on the other hand, can and often do buy millions of shares, drastically affecting price movement. With their established control, institutional buyers can make large purchases to drive prices up, open short positions to drive prices down, and sometimes even leverage inside information to profit from price swings they themselves create. To the average investor, this feels extremely unfair. After all, it means we're at the mercy with people with infinitely more resources than we do. But if you think about it, when is that not the case? For example, you can't afford to buy a cruise ship. So if you want to take a cruise, you need to call Carnival. It doesn't make the company inherently bad, nor does it mean you can't have fun on your vacation. It just means that you and the cruise company have different roles to play within the transaction. And if you take steps to limit your risk, it's perfectly okay. Stocks don't behave rationally. One of the most common complaints I hear from newer investors is that stocks aren't behaving rationally. This is an overly simplistic way of looking at stocks, wherein you think every ticker should respond positively to good news and negatively to bad news. And while this is sometimes true, the reality of how and why stocks move is far more nuanced. There are so many factors at play: psychology, market liquidity, speculative trading practices, and so on, that it would be literally impossible to consider them all. Believe me, if all it took to make money was for a company to put out a good press release, we'd all be wealthy forever. You can't time the market. If you're unfamiliar with the term "to time the market," it refers to attempting to buy and sell stocks or other financial assets at most opportune moments, therefore maximizing profits or minimizing losses. This is the overarching strategy of most day traders, almost all of whom statistically lose money. The same goes for options traders, whose statistics indicate have a failure rate of around 80%. And why wouldn't they? Attempting to time the market by predicting short-term price swings is a risky endeavor, especially for small investors. As I mentioned earlier, individuals simply don't have the same access to resources, information, or buying power as institutions. Remember what I said at the beginning of this video? These companies sometimes hold a small country's GDP worth of shares. So if your strategy relies on predicting short-term market movements, you're setting yourself up for potential disappointment. So how do individual traders profit? Obviously, there are plenty of traders out there making money. If this wasn't a possibility, nobody would bother investing anymore. So the question is, if the market is rigged, how are these individuals generating results? In most cases, these investors have accepted the nature of the stock market and altered their strategy to incorporate that truth. Being a quick profit day trader is the equivalent of a golfer heading out to the links Monday through Friday, expecting to hit 18 holes in one. A better strategy would be to work on your short game, buy new clubs, and take other steps to ensure you can better operate within the reality the game of golf presents. Here are some examples of how you can do this with stocks. Successful traders work to time general trends instead of trying to time the market. Successful investors tend to focus on general trends over the long term. After all, if you look at historical data, markets tend to trend upward in the long term. To capitalize on this, consider buying reasonably priced stocks with reasonable price to earnings multiples. If the stock declines, buy more. This can reduce your exposure when prices peak, and if you want to sell, put you in a position to maximize profits. The problem with this approach is that it isn't glamorous. It rarely involves major windfalls, and it doesn't allow you to go on stock twits and brag to your followers. On the other hand, it does work. And in the end, isn't that what matters? Embrace low-risk option strategies. Options are financial derivatives that give the holder the right, but not the obligation, to buy or sell a specific underlying asset at a predetermined price. They are often embraced by day traders and short-term investors, often with little success. But if you alter your approach, options trading can be a valuable tool for small investors looking to manage risk. Some low-risk option strategies include selling puts backed by cash in your account and selling calls backed by stock you already own. You can also explore more advanced strategies like calendar spreads, diagonal spreads, which allow you to take advantage of long-term trends. There are also bear and bull spreads, which can be used to capitalize on medium-term trends. And as with all things stock-related, focusing too much on producing immediate results is often what so often puts us at the mercy of stock market manipulators. As with all things stock-related, focusing too much on producing immediate results is what so often puts us at the mercy of market manipulators. Don't go all in on a single strategy. Almost every successful investor in the world will tell you that the key to long-term risk management is diversification. So why do so many traders insist on ignoring that free advice? Among my many rules of thumb for trading, I insist on never risking more than 10% of my resources on any single position. I would also never put all of my money into a single stock, even if I was 99% sure it was going to pop. In the end, investing isn't gambling. If you're chasing a thrill, you have to be prepared for the consequences. The main takeaway: play the long game. There's a reason why the words get rich quick are so often followed by the word scheme. For the vast majority of people, getting rich is a slow, deliberate process. And while that's hardly exciting, I'd like to remind you that when you come out the other end, you'll still be rich and a lot less stress from the process. So instead of chasing rapid gains, aim to build wealth over the long term. Utilize strategies that allow your earnings to compound over time, harnessing the power of patience and consistency. As Warren Buffett once wisely said, the stock market is a device for transferring money from the impatient to the patient. Considering he's worth $120 billion, I'd listen to him. In the end, anyone who says that the stock market is rigged against the small investor is only considering part of the story. While you may never be able to move markets like the institutional players, you can invest in ways that help you maximize your gains and minimize your risks over time. By understanding the market's dynamics, focusing on long-term trends, employing low-risk option strategies, and practicing responsible risk management, you can increase your chances of profiting from this complex but still potentially rewarding game. Thanks for watching. If you have any questions or comments, please post them below. And be sure to subscribe and hit that like button. Good luck with your trading.